Thank you and welcome to our Cumberland Market Update session today. Much has happened since we last spoke to many of you at our client quarterly on January 19th. We are moving forward in Canada with reduced COVID restrictions. We are witnessing market volatility, and now we have a war in the Ukraine to deal with. My name is Charlie Sims. It's my pleasure to be your host today. I'm joined by Peter Jackson, our Chief Investment Officer. Today, he will share our perspectives on the current situation in the markets and the war in the Ukraine. We look forward to responding to your questions at the end of the session. Please type your questions into the Q&A frame at the bottom of the screen during the session, and they will register with me. I will also take a minute at the end of the session to remind you how to ask questions. Peter, without further delay, welcome and thank you for attending today.
Okay, thanks, Charlie. Today I'm going to address two topics. One, the year-to-date economic and market developments, including the Fed and central bank action, the rising interest rates. Talk a little bit about what's going on in the economy and the outlook for earnings and valuations. And then secondly, we're going to address the Ukraine situation, including another look back at 2014 when Russia annexed Crimea. Also, the latest financial actions by the West to deal with the current situation, and then we'll touch on what we've been doing in the portfolios. So just turning to the next slide here. So our thoughts on interest rates in the market. We used this chart in our last client quarterly. However, I still thought it was relevant. In this chart, we look at the last taper rate tightening cycle that took place between December of 2013 through to December of 2018. And the point of this chart is not to suggest that history will necessarily completely repeat itself. However, there are a few points of similarities. First is that we have the same Fed chairman today as Chairman Fed Jerome Powell, as we did back then, for at least part of the last rate tightening cycle, who's well aware of the policy mistake that was made a little over 3 years ago when he signaled aggressive rate hikes to come, which led to the market sell-off in the fourth quarter of 2018. You can see that in the circle on the far right on the chart. He likely does not want to repeat the same mistake today, if avoidable. Another observation is that the S&P 500 was up 13.7% through the 2014 period in which the Fed reduced its bond buying program. That was the last tapering cycle. From $85 billion to zero, and that happened between January of 2014 through to October. And similar to what we're going through today, where the Fed has reduced their tapering this time from November of 2021 through to March of 2022 by $120 billion. And finally, the S&P 500 returned a total of 74.7%. That's shown in the middle circle there, from the beginning of the Fed taper in January 2014 through to September of 2018. That also encompassed a period of 8 rate hikes. So the big question really on people's mind today is how fast and furious are these rate hikes going to come at us going into this tightening cycle? Now, this chart compares the federal funds target rate in yellow to the 5-year minus 1-year forward Treasury yield curve spread, which is the black line, going back to the mid-90s. The point of this chart is that the forward yield curve inversion, that's the black line, falling below zero over on the far right there, typically happens at the end of a hiking cycle, not the beginning. And the ends of those cycles are marked by those dotted green vertical lines. However, since the black line is now falling below zero, it means that the yield curve is already inverting before the rate hikes have even started. It might be suggesting that the market's projection for the Fed rate hikes may be too steep. And if that's the case, then the market is already discounting and factoring in perhaps a lot of the bad news at this point in the cycle. Now, these two charts look at what the futures curve is building in for rate hikes over the next 12 months. The top chart is the Federal Reserve and the bottom chart is the Bank of Canada. And the implied probability over the next 12 months for the Federal Reserve currently is about 6 rate hikes, whereas for the Bank of Canada currently it's 7 rate hikes. So again, the market is pricing in a fair number of rate hikes over the next 12 months. Clearly, the future inflation and employment data will be key. However, supply chain bottlenecks are beginning to ease a bit, and we should begin to lap easier comps on the inflation side moving through 2022. Now, the impact on the market can be seen in this chart here. Whereas bond yields rise or interest rates go up, so do earnings yields. And earnings yields are simply the inverse of the price earnings multiple. In this chart, the light blue line, the one down 10.9%, represents the 12-month forward price earnings multiple, which has seen a fairly significant contraction during the first 2 months of 2022. And that's caused the market sell-off for the S&P, shown in the dark blue line, down around 8.8%. It's down about 8.5 at the close today. The good news is the forward 12-month earnings estimate is still rising, and that's the top gray line. Q4 reporting season was very, very strong. The actual blended growth rate was 30.9% positive year over year for the fourth quarter. Again, that was up from an estimated growth rate at the beginning of the quarter, December 31, of 21.2, so about 9% better than expected. And the 2023 earnings estimates are forecasted to be double digit, about 10.3% currently, and that's over the 2022 estimate. So the direction of earnings growth is critical, because if the move in interest rates is being factored into the market, there is room for forward earnings growth to carry the market higher through year end. So in this next chart compares the S&P 500 historical drawdowns going back to the 1960s. The red diamonds represent recessions, where the average bear market drawdown is negative 36%. You can see that in the middle of the chart. Again, lasting about 300 days, whereas the black diamonds represent the average drawdown excluding recessions of about negative 15.4%. Again, that compares to that down about 9% currently, lasting about 80 to 90 days. Now, this compares, as I said, to the current non-recession period we're in right now, which was down as much as about 12.5% last week, but has since recovered some of those losses. Just a reminder that the S&P 500 did peak on January 4th of this year. So if a lot of bad news on the inflation front, rate increases by the Fed, and the flattening of the yield curve is getting baked into the market, and with the market essentially through the correction territory of being down over 10%, perhaps the worst is behind us, especially if the economy does keep growing and earnings growth does hold up. This next chart is the New York Fed's probability of a recession. It's an indicator they use. It measures the difference between the 10-year Treasury yield and the 3-month T-bill rate. And this has consistently predicted essentially every U.S. recession since 1950, with only one false signal, and with a lead time typically around 4 to 6 quarters. Now, currently, this Fed model ranks the probability of a recession low below 10%. You can see that on the far right on the chart. So our best guess is that what we're seeing currently is more likely a healthy correction rather than a prolonged or significant bear market. So just switching gears for a minute, turning to the Russian-Ukraine situation. This chart compares the S&P 500 market behavior, which is the gray line, and the 10-year Treasury note, which is the blue line, around the time of the Russian annexation of Crimea in 2014. Now, as indicated, the 10-year Treasuries were rising, and the S&P 500 pulled back about 12.5% prior to the invasion, and the invasion happened almost exactly the same time in February as it happened here. And again, the market was down about a very similar amount, about 12.5%. As we also showed you earlier, this was the beginning of the last tapering cycle when the Fed reduced its bond buying program from the 85 billion level to zero through 2014. And as we mentioned also earlier, the market ended up almost 14% that year. So the military conflict is a grave concern to us. However, the reality is that unless this develops into something on a much more larger global scale, it may not be a long-term issue for the equity markets. Now, in terms of the latest developments over the weekend, This weekend's targeting of the 630 billion in reserves held by the Russian central bank is potentially a very powerful weapon in the West's financial arsenal. And it takes aim at the heart of the Russian financial system. The North American and Europe currently capture about 40% of those Russian central bank reserves, which are now frozen. The reaction today by the Russian central bank was to double their bank rate. So they took their interest rates up from 10 to 20%, which will likely paralyze their economy. Today's Russian central bank also banned all foreigners from selling Russian securities on their exchange. And notwithstanding these moves, the Russian ruble still was down 25% today relative to the USD. And the Russian MSCI stock market futures were down over 30% this morning. So S&P downgraded Russian debt also to junk. So there's a lot of financial pressure right now being put on Russia to come to the table and to end this. So in terms of what we're doing at Cumberland, again, we used this chart our last presentation. In this chart, we explore the performance for the S&P 500, excluding the 5 best and worst days going back to 2011. The point of this chart is to suggest that market timing can be a very rewarding tactical strategy. However, it's very difficult at best, and it's a tactical strategy that requires a high level of conviction. If you miss the 5 best days, you essentially lose all your return and then some. We show that in the second bar there on the left. We're not at the point where we have enough conviction to meaningfully reduce our equity exposure at this time. Based on where we see valuations now and based on historical periods similar to today, we think the best strategy right now is to continue to stay the course. Our main focus right now in the portfolios is to mitigate risk by transitioning away from higher volatility type companies into ones with more stable earnings outlooks. So in conclusion, we've seen a significant pullback in the first 2 months of 2022. However, earnings are still growing. The overall economic outlook is still strong, and financial markets appear to be discounting quite a bit of the expected increase by the Federal Reserve. Situation in the Ukraine is fluid and worrisome, but likely short-lived, in our opinion, given the financial pressures being imposed on Russia at the moment. So as a reminder, our focus at Cumberland has always been to buy high-quality companies. We have strict criteria in terms of the profitability and stability of the cash flows and earnings. And this process has allowed us to navigate successfully through some of these tough times like we're in right now over the past couple of decades. Now, the outcome of our process leaves us with a portfolio with characteristics shown in this slide here. And this slide compares the Cumberland North American plus International, as well as the Cumberland Global portfolios to the appropriate benchmarks that they follow. As indicated by both portfolios, they have very high profitability characteristics as measured by return on equity, return on invested capital, and EBITDA margins. And they're also less volatile or lower risk, as shown by the beta, the standard deviation, and loss standard deviation shown here in this slide. We think this increases the likelihood of us outperforming. And we've proven this through back testing and by tracking the performance of our scoring universe of investable companies over time. Also, our ESG score, or environmental social governance score, is better than the bench. As you can see, in this case, lower is better, which we do monitor as well for all our strategies, and all our strategies are better than their benches, such that it's a positive byproduct from the quality focus investment process that we use here at Cumberland. So, Charlie, I'm going to stop there and see if there's any questions. Thank you.
Great. Well, thank you very much, Peter. I know it's been a busy weekend, and this is a situation, particularly with Ukraine, that is free flowing and changing all the time. We'd be pleased to answer any questions. We're using the Q&A function at the bottom of your screen. If you would like to type in your question, it will show up on my screen, and I will consolidate that with other questions being asked and ask one of our partners who are on the line to answer. Peter and I are joined by Phil Diorio, Phil is one of our senior portfolio managers. He's a partner in the firm, and he's responsible for some of the international and global mandates that we use, as well as US security expertise. We also have Owen Morgan on the line with us today, who works with our fixed income team and can respond to any questions that you might have there. I am seeing a few questions pop up right now. So Pete, I'm going to just let the group think about a few more. But in the meantime, Peter, the situation in the Ukraine seems scary to most. Are there any similarities that you saw when markets corrected in a big way in 2008 or 9?
Sure, Charlie. At the moment, I would say no. One thing that people were focused on was the LIBOR rates, or the essentially what rates banks lend to banks back then, because we got to a point back then where the banks didn't trust each other. And the LIBOR rate was running around 10 basis points when we had that Lehman moment back, I think it was September 15th, 08. The LIBOR jumped up over almost 4%. And in the last 30 days, we've seen the LIBOR rate climb from about 30 to 49 basis points. So it's up slightly, but we're not seeing anything like we saw back during that period.
Have you got some thoughts you could share with us on the most interesting sectors that you're seeing right now? You commented you were restructuring the portfolio, or thinking about restructuring the portfolio a little bit to change the risk profile. Is there anything from a sector perspective that you would guide us to at this point in time?
It's almost stock by stock. The one thing we're looking at from a portfolio perspective is just the overall beta of the portfolio. So we've been selling beta and buying companies with overall less volatility, and names like TFII, which has been a great performer. We more than doubled our money in it, but again, it's highly economically sensitive. It's got a very high beta. It's reflecting a lot of the positive developments. Again, if the issues around moving products are starting to sort itself out, then it's possible that we may have seen the best days for that one. So those are the types of names we would be reducing. The names that we're adding to are the ones we can see fairly high conviction level of earnings. Rogers Communications has been a name where we think this deal will go through. There's an announcement today that they're going to have to divest the Shaw wireless assets, which means that CRTC is basically saying that they're going to approve it. So we see high visibility in a name like that. Other names that we've been putting more money into are the Canadian Pacific Kansas City Railroad. Again, another acquisition that's going to create tremendous amount of synergies from that transaction. Intact Financial is another name with very, very low beta financial that has benefited tremendously from their RSA acquisition in the UK. So those names all have very, very good earnings runway, and that's really the focus of what we're trying to invest in, companies that we have a very high conviction level with the future of earnings, even if the economy does begin to slow.
Great, thank you, Peter. What are your thoughts on the price of oil, medium to long term, and will that be a source of inflation or contribute to inflation in any way in your mind?
Is that for me?
Yeah.
Well, the answer is it already is contributing to inflation. The biggest drivers of inflation are essentially food and energy. And so that's been the material driver of why we're seeing inflation up as much as it is. I think there's a big war premium built into the price currently. So we'll see how things unfold over the next weeks and months. I think that there'll have to be some type of logistical reshuffling of where oil goes in the world. I saw some interesting charts this morning on fracking levels in the US, and they're now back at where they were pre-COVID. So the US production is going to start to ramp up quite materially, I think, over the next year or so. So that will be another source of supply.
And any thoughts on OPEC's ability or willingness to want to contribute to managing their output in a different direction?
There's not a lot of excess capacity right now within OPEC. So, there's some production that could come out of Iran if a deal can be done on the nuclear side, but there's not a lot of excess capacity right now within OPEC. So I think it's going to have to be brought on. So it will take a little time.
And then you talked about the 630 billion of Russian reserves, and much of that is being frozen. Certainly, everything that's being held outside of the country and in the financial institutions that the various governments around the world are targeting. The question from one of our attendees is that going to severely limit their ability to access capital, fund the war, pay their bills, etc., or can they manage with what they have access to in their own country?
It will limit it. I think that's the whole point behind it. With the sanctions, there just won't be a lot of I guess liquidity flowing in and out of the country. And then when you add on top, this was the reserves that were more or less set aside to help fight the war. And it's not all trapped. China represents about 14% of that 630. Again, the numbers here are about 6 months old. So, but that's the best we've got. China's about 14%. There's another 22% that's held in gold. So there's, they still have reserves. They're not down to zero or anything, but they have been severely limited by the likes of what Europe was holding, what the UK was holding, what Japan was holding, Canada, Austria, other countries like that. But they probably still have about a third of that 630 million available, Charlie.
Pete, maybe I'll give you a break for a second, and Phil, over to you. Do you want to give us your thoughts on the value of tech stocks with the correction and what you've seen in the market in the last little while, and maybe even in relation to what's going on in the Ukraine?
Yes, the tech stocks have bore the brunt of this correction that we've seen. So a lot of the names that we own have materially been hit in terms of their valuations. Thankfully, we're not invested in that non-profitable area of the technology world, which, share prices for non-profitable tech have been hit anywhere from 50 to 80%. A lot of the companies that we own would be down more in the 15 to 20% range. So kind of that's part of the analysis that we've been doing right now, looking for opportunities. And it's if we liked them before, we like our companies even more now, given the valuation that's transpired here.
Peter, Phil, is there a chance that China could intervene to mitigate the financial levers that the West was bringing to bear against Russia? Further to our last question, Peter.
Yes, that's what I was implying by the sort of logistical shifts. I mean, they could start buying more goods from Russia, whether it be oil or whether it be wheat. I mean, Russia's a big producer of both oil, both wheat, aluminum, platinum, palladium. Those are sort of their key commodities. So yes, that's a risk.
And we have a question here on our rates of return and our structure and our services. And I just remind everybody who's in attendance, and we have over 100 people attending today, that we have a number of different strategies and a number of different asset mix allocations. So if you want to reach out to your client portfolio manager, if you're joining us for the first time, you can flip an email to our information page, and we'd be happy to respond more specifically to the question that you're looking for relative to an equity mandate, a balance mandate, an income mandate, or whether we're investing globally or domestically. The next question that is here is it's back on the inflation, and do we Do you think this is going to elongate the inflationary pressures of the supply chain delays in any material shape or form, Peter or Phil?
I mean, I would say that in the short term, it is something that can aggravate the inflation situation. Russia sends a lot of gas and oil to Europe, and then it's also known as the breadbasket of the world, supplying a very large percentage of the wheat to the world. And then Ukraine is also a big exporter of agricultural commodities to the rest of the world. So in the near term, if this remains how it is right now, it does have the potential to exacerbate an already high inflation level. My own personal view is that cooler heads will prevail. I'm not sure how long this will go on for, but as Peter alluded to, there's a lot of pressure right now on Russia. So in the near term, the answer is yes, it can exacerbate the situation.
Great, thanks. Again, I'd remind you, if you do have a question, you can type it in. Peter, this is one we addressed it a little bit earlier, but maybe a little more detail since it's coming up again. How are the portfolios positioned from a sector weighting perspective, and possibly even a style perspective? And I know you talked about our quality approach, but that does move the portfolios around between sectors and between styles slightly.
Yeah, I mean, we're still got a value bias to the portfolio. I don't have that in front of me at the moment, Charlie, but I put it up on one of our slides at our last quarterly in January, and it's kind of tilted, 60-40 towards value for the North American plus international. So that really hasn't changed a whole lot. It's really more about the dynamics around the volatility that I've been trying to bring down. So I tried to address that in that last question. That's really been the main focus. The overall value growth tilt, it might have changed 4 or 5%, but it wouldn't be material swing from one to the other.
Platinum and palladium. Russia's a big supplier of those minerals and metals around the world. But from my perspective, we previously talked about copper and other sources for electric cars, etc. Do you have any thoughts on whether that will disrupt things in the near term or medium term, or are there other sources?
Russia's not a big producer of copper, so the answer to that's not really an issue. Platinum, palladium, they are big producers of that, so it is an issue. The good news is that there's not a lot of platinum, palladium used. It's relatively small amounts, so I don't expect it's going to have a large effect on the overall inflation front. There's just not that much consumed of platinum, palladium. But again, it just ties back into that whole inflation issue that Phil addressed. Those commodities are going to go up in price until this thing sorts itself out. There's no question about that.
Well, we've come to the end of the session from a live question perspective. I just wanted to take a minute and thank everybody for attending on short notice. It's clearly a topic that's on everybody's minds with respect to what's going on. We'll continue to watch it. We'll continue to evolve. And if we feel things are changing in a material way, we'll invite you to attend another call. In the meantime, we have a previously scheduled call happening on Wednesday, where we're going to have some of our partners give an overview of solutions within private debt or alternative investments. So we hope that those of you who haven't already signed up and might have an interest in that topic would join us on Wednesday. To Peter, thank you for preparing your comments today. To Peter and Phil, thanks for responding to questions. And most of all, to each of you who joined, thank you for taking time out of your day to learn a little bit more about what we're thinking. And thanks again for the trust that you provide in us in allowing us to be part of your wealth management solutions. I hope everybody has a nice evening, and thanks again for attending.